California's housing market is standing on a cliff, and 2026 is the drop. Warning signs flash everywhere, but most sellers keep looking the other way. Monthly costs climb while approvals quietly disappear. Premiums don't just rise, they rewrite the rules. Deductibles spike, coverage shrinks. Carriers pull back from entire ZIP codes. Nothing about the property changes, but the escrow blows up. Lenders rerun the math, and the clear to close becomes, we need to talk. Meanwhile, taxes and fees keep stacking. Assessments reset on sale. HOAS push temporary hikes that never roll back. Utilities creep higher. The monthly grows heavier even when the sticker price doesn't move. Buyers don't shop for granite countertops. They chase a number they can actually live with. And when that number breaks, demand collapses first. Now add fresh friction. Quiet tech layoffs, remote work pullbacks, commutes that ruin the dream listing, and a coverage market that treats fire zones like a different planet. Builders fight with buy-downs. Private sellers chase those payments and fall behind. Appraisals follow the deals that actually close, not the listings that pretend. This isn't a mood swing, it's a sequence. And once the lines stay crossed long enough, prices don't drift, they slide. And it begins with the hidden killer inside every deal, the insurance policy. Coverage crisis. The first domino isn't price, it's protection. Wildfire insurance has become the silent wrecking ball. Premiums in high-risk counties have doubled or tripled in just a few years. Major carriers have pulled out, leaving buyers stuck with more expensive state plans that offer less coverage. A deductible that once sat at $1,000 can now be 5% of the home's value, $30,000 on a $600,000 property. The house itself hasn't changed, but the escrow has. Lenders rerun ratios, approvals wobble, and buyers walk away. It hits hardest in fire corridors like Napa and Sonoma, but no county is immune. One blaze 100 miles away can reset risk models statewide, spike premiums, and shrink coverage overnight. That's where deals quietly die. One failed binder looks unlucky. 10 in the same subdivision signals real price discovery. Savvy sellers take control. They shop policies early, attach bindable quotes, and fix issues before underwriting stalls. New roof? Show the paperwork. Trees cleared? Prove it. Certainty attracts buyers. Investors go further. They underwrite worst case. Higher premiums, bigger deductibles, flat rents. If the math still works, it's real. If not, better to kill it on paper than bleed later. But insurance is only the opening move. What follows is built into the system. California's tax structure makes sure payment pressure never goes away. Taxes and hidden costs. The monthly doesn't just rise with premiums, it's squeezed by California's tax system. On paper, Proposition 13 looks like protection. In practice, it punishes new buyers. The moment a property changes hands, the assessment resets to full market value. Sellers on decades-old rates pay a fraction of what the new owner owes. That reset alone can add hundreds per month before insurance or utilities are even counted. And that's just the start. HOAS raise dues for wildfire cleanup or temporary upgrades that never roll back. Cities tack on bond repayments and local fees. In newer subdivisions, mellow roost levies act like a permanent second bill. Utilities tilt the scale too. Older homes waste energy, newer builds carry higher baseline charges. This is where budgets snap. A loan that looks safe on paper suddenly feels tight once escrow includes the real bills. Two similar homes in different districts can mean a $400 monthly swing, deciding who can bid and who can't. Builders know this. They don't just lower prices, they attack the payment with rate buydowns, closing cost credits, or promotions that erase part of the squeeze. Private sellers can't match that. Their only tool is to cut, and once they cut, comps follow. The trap is timing, reassessments hit in cycles, HOA hikes mid-year, utilities creep season by season. Each chip erodes buyer confidence and reduces offers. Owners who prepare win. Showing records of bills and realistic escrow projections builds trust. Sellers who ignore the burden usually pay later, when silence forces a reset. Taxes don't just weigh buyers down, they lock the monthly in place, and that leaves little room to absorb the next wave. New supply flooding the market. Supply wave. Supply doesn't knock, it kicks the door open. California's massive pipeline from 2021 to 2022 is hitting the market in 2025 and 2026. Entire subdivisions in the Central Valley, Inland Empire, and Sacramento suburbs are finishing at once. Builders don't slow down because demand looks weak. They finish what's already under construction. The shock shows up first in rentals. Lease-ups drag on. 1 month free banners hang across complexes, and effective rents slip. Investors see it on the P&L. Costs rise while revenue softens. That's when the hold forever story wobbles. When rents weaken, sales follow. On the fence, buyers notice cheaper renting and pause. Builders respond with rate buydowns and closing credits. Private sellers can't match those tools, so they chase with price cuts. Appraisals don't reflect listings, they follow closed contracts. That's how soft rents become soft comps. A subdivision doesn't need a crash, just enough competing units. Buyers feel the leverage shift and wait. Supply alone doesn't crash a market, but it tilts the field. And when demand is already strained by insurance, taxes, and costs, the flood of new homes becomes the weight that tips the balance. The result is a fragile calm. Charts look steady, but leverage quietly slips away from sellers. Fragile plateau. Flat lines fool people. On the surface, California's housing charts look steady. Median prices hold, inventory inches up, and sellers think they're safe. But leverage has already shifted to buyers. Days on market stretch, inboxes go quiet, and the first signs are concessions. Rate buydowns, closing credits, small cuts dressed as incentives. A plateau isn't stability, it's pressure in plain sight. Sellers still list high, but serious offers only come after silence. By the second or third weekend, they're negotiating with reality, not nostalgia. Buyers catch on fast. A lingering listing feels tainted, and each week sharpens the discount. Stubborn owners harden, signaling weakness the longer a home sits. Multiply that across a neighborhood, and you get slow-motion repricing. Median stats can't show it, but street by street, deals close below sticker. Sellers eventually reset, first with credits, then cuts, then deep reductions to bring traffic back. This is where patience fails and strategy takes over. Builders prove it next door, slashing payments to move inventory, while private sellers fight shadows. That's the fragile plateau. Calm on paper, erosion underneath. And the next stage shows how erosion accelerates when builders go head-to-head with private sellers in a payment war. Builders versus private sellers. Builders don't sell houses, they sell payments. National giants like Lennar and KB Home have tools private sellers lack. Temporary rate buydowns, prepaid HOA dues, closing cost credits, even upgrades that save buyers real cash. For buyers, the math is simple. The monthly looks cheaper, even if the sticker price is higher. Appraisers don't care about list prices, they follow closed deals. And those deals are anchored by builder incentives. Neighborhood values bend toward whatever monthly the builder creates, not the number private sellers hope for. Private owners chase. At first it's small concessions, covering escrow fees, a cosmetic cut, then deeper resets just to draw traffic. The resale doesn't compete with the listing, it competes with the builder's financing sheet. Savvy sellers flip the script. They pre-shop insurance, attach bindable quotes, and offer credits that target the monthly directly points, escrow, and PMI. The goal isn't defending yesterday's price, but beating today's builder payment. This is the payment war, and builders set the pace. But incentives only work if lenders keep approvals flowing. Once credit tightens, even the biggest discounts can't save a deal. Credit tightening. Prices don't fall from panic, they fall when approvals vanish. Lenders track risk closer than anyone. When defaults rise or zip codes look shaky, they tighten guidelines. Debt-to-income caps shrink, credit score minimums rise, cash reserves grow. That comfortable, pre-approved suddenly becomes come back with more down. Strong borrowers still close, but the edge disappears, and it's the edge that sets the highs. Without aggressive bids, comps slide quietly, then broadly. For investors, the squeeze is worse. DSCR loans tighten, spreads widen, refinancing slips out of reach. Deals penciled for 2026 die on paper. Some hold, some sell, but comps from forced exits drag everyone else lower. Credit is oxygen. Less oxygen lowers ceilings. And when the ceiling drops, every other pressure insurance, taxes, supply, lands heavier. That's why the next factor matters. Migration math. Headcount doesn't pay the mortgage. California always churns. Millions move in, millions move out. But 2026 isn't about long-term trends. It's about who can qualify today. With insurance, taxes, and credit all tightening, raw population numbers don't lift prices. The mix of movers matters more than the volume. Fewer equity-rich buyers arrive, while more payment-sensitive families chase budget homes. That shifts demand downward, leaving mid- and high-tier listings to sit. Outbound migration adds supply. Retirees and remote workers cash out and move to Nevada, Arizona, or Texas, where monthly costs bite less. Every departure adds inventory, competing with builder discounts and tighter credit. Even inbound buyers hesitate. A family relocating from Seattle may love California's weather, but pause once they see tax bills, HOA dues, and fire zone premiums. Intent turns to indecision, then to stalled offers. The result? Busy open houses at the entry level, silence in luxury. Headlines show activity, but comps reveal softness. Migration keeps the market moving, but it doesn't guarantee higher prices. And when climate risks stack on top, even approved buyers face a new problem: coverage that changes overnight. Climate and disaster risk. The weather writes the rules. In California, one wildfire, flood, or quake season can reset the market. Carriers don't just raise rates after disasters, they rewrite coverage. Roofs age faster on paper, deductibles jump to percentages, and exclusions appear where none existed before. The change feels invisible until the binder lands. Buyers who thought they could stretch suddenly can't. Sellers scramble with credits to keep deals alive. Appraisers see concessions, underwriters tighten, and lenders trim approvals zip code by zip code. It's not theory, it's math. Billions in claims push carriers to retreat, quotes spike, and the buyer pool shrinks overnight. The property hasn't moved, but the financial risk has, and that flows straight into pricing. Sometimes areas don't lose insurance entirely, just choice. Fewer carriers means slower quotes, tougher inspections, higher costs. Each layer cuts out another set of buyers already squeezed by taxes and credit. Smart sellers come armed. Roof reports, inspection histories, bindable quotes. Reduce unknowns. Keep buyers at the table. Ignore them, and silence follows. Climate doesn't need to be catastrophic, just consistent. And when monthly pressure stacks, another group feels it hardest. Investors watching cash flow shrink. Investor squeeze. Cash flow doesn't care what you paid. For California investors, the math is breaking. Premiums climb, property taxes creep, utilities eat margins, and rents don't rise fast enough. Net operating income shrinks while cap rates edge higher, pushing valuations down even if streets look stable. Bridge loans and adjustable debt reset in 2026, making the squeeze worse. Refinancing gets harder as lenders demand stricter ratios and bigger reserves. A refi that looked safe 2 years ago suddenly doesn't pencil. Owners face a choice: sell early or bleed cash waiting. Under pressure, operators cut in the wrong places. Maintenance slips, vacancies widen, concessions spread. Hold and hope turns into list and leave. Not because the property is bad, but because the math stopped working. Smart investors adjust early. They prioritize capital expenditures that lowers bills: insulation, efficient systems, water retrofits. They model higher premiums and steeper taxes from day one. They build reserves for deductibles instead of pretending disasters won't come. But investor stress spills into comps. Fire sales and quick exits drag valuations for everyone. Once those sales close, appraisals follow lower. That's how landlord pressure turns into market pressure. And the next stage shows how, when appraisers stop chasing wish prices and lock in distressed deals. Appraisals and comps reset. The only price that matters is the one that closed. Listings can dream, but appraisers work off real contracts, net of credits, buy-downs, and concessions. When builders clear inventory with heavy incentives, those adjusted numbers anchor the neighborhood. On paper, values look steady. In practice, every appraisal leans lower. A street can feel stable while comps quietly slide. Sellers notice when multiple lenders cite the same discounted sales. Buyers feel it when approvals shrink after appraisal cuts. The gap between asking and appraised value doesn't just stall deals, it resets them. Private owners misread this moment. They price off yesterday's comp, only to see appraisers pull them back to today's reality. The longer they resist, the more leverage shifts to buyers. Smart sellers package their value, document upgrades, Appraisers can adjust for, attach insurance quotes, and offer credits that lower the monthly instead of cosmetic perks. Investors sell into clarity. If numbers look bad now, they'll look worse in 90 days. Better to exit early than sink with the comp pool. This is how a plateau turns into gravity. Contracts close lower, appraisers lock them in, and the market starts moving where the deals really landed. Financing tricks and pitfalls. Cheap money isn't always cheap. Temporary buydowns. 2-1s, 3-2-1s make year one look easy, which is why builders love them. But month 13 tells the truth. Payments jump just as insurance renews and tax escrows reset. Buyers who only qualified at teaser rates often end up back on the market. Permanent buydowns with points sound cleaner, but only if the math works. Divide the cost of points by the monthly savings to find break even. If you won't hold the loan past that, you just handed the lender free money. Seller credits can be powerful if they hit what lenders care about: points, escrow, PMI. Cosmetic upgrades don't move debt-to-income ratios. Approval's clear because the monthly works, not because the kitchen shines. For investors, the math is harsher. Stress test at today's rates plus another 100 to 150 basis points. If the deal survives, it's real. If not, better to know before closing. Financing tricks can bridge gaps, but used wrong, they set buyers up for failure and sellers for resets. Used right, they win the payment and keep approvals alive. But even sharp financing can't stop what's coming in 2026. Pressures don't hit one by one, they stack. 2026 convergence timeline. The pressure doesn't land once, it stacks. Q1 2026. Insurance renewals hit mailboxes. Temporary buydowns from 2025 deals step up. Lease-ups toss concessions, pulling renters off the fence. Tax notices cut approvals just as spring listings launch. Silence comes first, then credits, then cuts. Q2 2026. Spring inventory peaks. More contracts close with points and buydowns. Anchoring comps below sticker. Fire and hail season trigger claims. Carriers tweak terms. Premiums rise again. Adjustable loans from 2021 reset, pushing owners to sell sooner. Builders defend with deeper incentives. Private sellers trail. Q3 2026. Wildfire season collides with back-to-school slowdown. New tax bills load into escrows, approvals tighten further. Investors run YTD numbers, NOI doesn't lie, and many sell before year-end. Builder clearouts drag comps lower. Q4 2026. Builders run blowout discounts, investors exit for tax reasons, adjustable rate loans reset higher. Appraisals for 2027 are anchored by a full year of net price closes. Headlines finally catch up, but local numbers showed it months earlier. Affordability sets the floor, credit sets the ceiling, supply presses both. By mid-2026, those lines stay crossed long enough to move prices, fast in zip codes where risk, resets, and inventory cluster. Who breaks, who holds, how you win. Who breaks first? Thin equity owners, short-term rentals in oversupplied pockets, landlords on bridge or adjustable debt, and high-tax or high-risk counties where coverage is scarce. Luxury stalls sooner, fewer, pickier buyers, and those stretched on temporary buydowns without a plan for month 13, they're back on the market pulling comps down. Who holds median-priced homes with low operating costs, good roofs, efficient systems, manageable taxes? Owners locked into low fixed mortgages with no reason to sell. Neighborhoods tied to durable job hubs like healthcare or logistics, HOAS with lean, transparent budgets. Who wins? Cash buyers in late 2026 set the new floor. Owner occupants who aim credits at permanent costs, points, PMI, escrow, get approvals others can't. Smart sellers price against builder payments, not nostalgia, and attach bindable insurance quotes. Operators who cut costs and lift NOI beat cap rate drift. The pattern is simple, the monthly rules. Whoever controls it wins. 2026 isn't doomed, it's a reset, and resets reward those who move early. If you're an owner, sell the number, not the memory. Pre-shop insurance, fix roof and system issues, attach clean docs to your listing. Price to beat the builder's monthly, not last year's comp. If you're holding on a low fixed rate, spend 2026 improving the asset and documenting upgrades. If you're a buyer, structure to survive year 2. Get multiple insurance quotes before committing. Run renewal math, not just closing math. Compare permanent points by break-even, and if you take a temporary buy-down, build a reserve for the step-up. Always shop against the builder's effective payment. If you're an investor, underwrite ugly and operate sharp. Model heavier costs and a wider cap rate exit. Cut expenses that hit the next bill, utilities, maintenance waste, inefficiency. Fund reserves for deductibles. Sell into clarity if refinancing won't clear. The rules are clear. Insurance keeps the monthly heavy. Taxes lock it in. Credit shrinks the buyer pool. Supply forces sellers to bend. That's the sequence. 2026 is the hinge year. Don't fight it, map it. Control the monthly, package certainty, and you won't just survive the reset. You'll be the one setting the new comps when the dust settles in 2027. And if you want the signals city by city as they hit, subscribe now and turn on notifications so you move before the averages catch up.